Join us now with more on the market. Stephen Parker, co-head of global investment strategy at JPMorgan Private Bank. Did you tell everyone to buy on April 2nd?
We were telling, number one, the most important thing was we were telling clients to stay invested. You know, there was an instinct to sell as, you know, uncertainty rises, and the number one message was stay invested, stay disciplined. Diversification obviously helped in that. And then we were looking for opportunities selectively, but it was more about keeping clients where they were.
Would you be adding or subtracting now?
Well, now that markets have rallied and we're actually getting closer to what we think our base case target is for the end of the year, I think it's about being a little bit more selective. So three things. One, for clients who are still sitting on too much cash, particularly for their long-term money, put that cash to work. We think stocks are going up.
Right now, put it to work.
Yeah, put it to work. Get to a normal level of risk. Number two, you want to look for opportunities where you can find stronger earnings growth. So you just talked about AI. We think the software story on the AI expansion is a big opportunity, as well as banks, who we think will be the biggest beneficiaries of deregulation. And then the last one is about global diversification, which has been a big theme this year. We actually think the potential total returns for markets like Europe are actually higher than the U.S., especially for dollar-based investors.
What happened? And I'll tell you what, I was looking at, I don't know, one of the financial news sites this morning. I can't find it now. But it struck me, the headline was, this key inflation indicator hasn't budged in the age of tariffs. Why? And will it?
You know, I think we talk a lot about this. We just released our mid-year outlook, and the theme behind it is comfortably uncomfortable. And I think that there's going to be a lot of noise in the headlines. I think the inflation measures haven't really moved because, you know, the tariffs haven't really kicked in, right? There was a lot of front loading around imports to start the year. And, you know, as a result, we haven't seen the big impact on prices. The question is, how does that proceed from here? As those tariffs do begin to kick in, we're watching a lot of real-time inflation indicators. And while prices have picked up a little bit, not to levels that we would be panicking.
I mean, there should be something even before they kick in, either people anticipating they're going to need to raise prices. It's same with the other side. I could also see a headline, I didn't see one, but I could also see a headline that says, these indicators of a slowdown and a result of all the uncertainty that everyone's feeling with consumers across the board, companies, we still haven't seen a slowdown.
No, I mean, you've seen a huge disconnect between what people are saying and what people are doing. So the soft data, like consumer confidence, sentiment surveys, has plummeted. The hard data, what people are actually doing, consumer spending, labor markets, remain strong. Now, over time, those two things are going to have to converge. The question is whether the hard data slows down to meet that downturn in sentiment, or if the sentiment begins to get better. That seems to be the direction of travel, and we saw some slightly better news on the consumer confidence front yesterday.
We've had a lot to worry about, a lot of pearl clutching, worried about the bonds, worried whether we can ever sell another bond, whether people around the world are going to stop buying bonds for whatever reason. They don't like the United States anymore, whatever reason. Will that be put behind us eventually? Is that a false
I mean, here's the ironic thing. The rate on the 10-year Treasury is lower today than it was at the start of the year. So, you know, there is a lot of concern around bonds, around the dollar status as a reserve currency. We don't think those things are going away. And in fact, you know,
the concerns or that it is a reserve currency?
We don't think that there is. We don't think that the dollar status as a reserve currency is going away.
Okay.
When it comes to the bond market, rates can go higher for a couple of reasons. You know, inflation is obviously the negative outcome, but at the same time, growth is a positive reason why rates can go up. And that's why bond yields, I think, were higher at the start of this year. And so if we start to see some reacceleration in the growth picture, I think we can sustain higher rates.
I was going to say, it's not just the United States that is having issues with this. Bond yields are higher around the globe at this point. Part of that is you have central banks that aren't buying like they used to.
That's right. It's a different monetary environment than the last cycle. In fact, you know, we think that the next cycle is going to be characterized a lot more by fiscal spending and fiscal support rather than monetary policy and low interest rates, which is what we saw last time. In the long term, that's actually a good thing because it means better growth rather than necessarily lower rates.
We'll see highs this year in the S&P, yes or no?
Yes.
New highs?
I think we'll see new highs this year in the S&P.
we back to 7 or 8% per annum, or are we? I mean, we had 3 straight 20% plus.
Yeah, I mean, it's been a great couple of years for the stock market. Our view is that you probably see, mid to high single digits, from over the next 12 months. But like I said, some of those more targeted opportunities, particularly outside of the U.S., I think can give you even more upside.
Where outside the U.S. is your favorite?
So Europe is our top call right now.
It is?
Yeah, we actually think that there's a really good domestic story, which you haven't seen in more than a decade in Europe. You see it with the fiscal policy in Germany. You're also getting higher dividends. In Europe, you get 4% a year paid to wait. You get discounted valuations, and then you get that diversification story. The dollar, we see further downside from here, even after the dollar is weakened. Yeah. And for U.S.-based investors, that's a tailwind.
So they're looking over here and finally figuring things out, or why?
I think that they're realizing that the uncertainty on the policy front is forcing,
like we did over here, too.
Is forcing Europe to reassess. The willingness to spend in Germany is not something that we've seen in a long time. And so, I think some of the negatives that came with the uncertainty are potentially turning into
a lot of things.
Positive.
Net zero, that's going nowhere over there. And I saw the NATO, the guy heading it say, we're going to be at 5% with all of our members.
Yeah, I mean, there's
finally. So they're finally.
There's a big push on energy, defense, on infrastructure. Yeah, those are all positive for the European economy.